This is the Burnett Plaza, a 40-story, 1.02 million square foot office building, the tallest building in Fort Worth, Texas. This building sold in 2021 for $137.5 million, but it recently sold in a foreclosure auction for just $12.3 million. That's a loss of over $125 million. Billionaire investor Barry Sternlicht is expecting bank failures to become commonplace, given ongoing commercial loan losses in the USA. Have a listen to what he said this week about his expectation for U.S. bank failures coming on a weekly basis.
I do think rates will come down. I think they'll come down for two key reasons. Like Powell looks like he's looking for a reason to bring them down. And he has to be aware that we have a $34 trillion deficit and he can pay 4% on that or 5%. And just on the debt rolling this year, the delta is over $130 billion. The difference is 1 point, which the U.S. government is going to have on a flywheel of. So he's aware of that. And the second thing is the regional banking market system. You know, with $1.9 trillion of real estate loans, that's a fragile animal right now. And one way to get capital into those banks is to lower rates. So it basically makes the assets worth more. And I think also the whole real estate complex, we're sort of an accidental, unintended consequence of his. He was trying to lower inflation, food, energy, which arguably, is he going to impact oil imports with interest rates?
Or home insurance rates.
Or home insurance rates, or food supplies from Ukraine, which jack up wheat prices. And he's working with a very different economy, where since he started raising rates in May of 22, the healthcare, government education industries have added 3 million jobs. So he's not impacting that at all. And that's almost 50 million of 160 million jobs. So he's got a hard task with a blunt tool. And the consequences are the real estate markets are taking it on the chin because rates rose so fast. We could have handled this, but we couldn't handle it this fast. And people are looking for these cracks, and you're going to see the cracks develop now. You're going to see a regional bank fail every day. And not every week, maybe 2 a week.
Market analysts at commercial banks such as UBS are now floating the idea that the spot price of gold could nearly double within the coming 2 to 3 years. There are unbacked hundreds of trillions of reasons for this, and we'll cover a few of them in this week's SD Bullion Market update. First, Tabby Costa cites over 10 reasons on the right-hand side of this gold versus fiat US dollar spot price chart for why this building gold bull has lots of room to run to come. Now, coming reversion towards the historical norm of much larger gold investment allocations is but one reason. A doubling of the gold price by the second half of this decade is not out of the question. World governments and their central bank partners have been net buying bullion in record volume since 2022, and their building preference for bullion over bonds shows no sign of slowing, but instead regressing to the historic average of 40% gold bullion allocations throughout this full fiat currency era. Ever since the freezing of Russian central bank assets by the United States government, net central bank gold buying has gone next level. And when asked, emerging market central banks cite they are increasingly buying gold bullion as a hedge against geopolitical risks and ongoing sanction concerns. Even in the face of relatively strong fiat US dollar values versus other devaluing fiat currencies, and even with real yields rising, both gold and silver have been performing relatively well, regardless, in their fiat US dollar terms. Gold has clearly broken out, and it is currently threatening to drag stubborn silver along with it, as it's again threatening another run at the $38 an ounce tamped down resistance level. Brent Johnson of Santiago Capital just updated his G8 China and Switzerland fiat currency aggregates versus official gold piles by region. On a net basis, to back the amount of hard fiat currency, the physical bills that are outstanding, with official gold requires a current spot price north of $14,000 an ounce. Even a move back towards the historic 40% coverage level requires gold to be priced over $5,700 an ounce at the moment. In U.S. financial history, a 40% coverage of the outstanding currency issuance versus gold price, it's already happened 3 times. During the Great Depression, when about 3/4 of the U.S. population did not turn in their gold coinage, and twice during the 1970s gold bullion bull market era. My expectation is we have another future convergence with the blue line at the very least before this building gold bullion bull market mania phases and peaks out. Well, stick around. On the other side of this break, we will examine how the ongoing rating of unsecured ETFs for their underlying bullion holdings is a predictable move to meet ongoing precious metal market supply deficits, ongoing in gold, silver, and platinum. We'll show you how in recent financial history, rating ETFs for underlying physical bullion has been followed by a raging precious metal spot price. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates, and be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
Want to win 500 Silver Tree of Life coins from SD Bullion? Enter and you could be the next lucky receiver of a phone call like this.
Hello. Hi, Stuart. This is Dr. Tyler Wall, president and founder of SD Bullion. And I'm calling you to let you know that you won the SD Bullion giveaway of a monster box of 2023 Silver Eagles.
Oh, my God. You got to tell my wife this, because she's not going to believe it. Honey? Okay, doctor, let her know.
Yeah, this is Dr. Tyler Wall. I just let you know that you guys won the monster box of 2023 Silver Eagles giveaway from SD Bullion.
No way.
Yeah?
She would never believe me if I told her that. I'm online all day long with your website looking for deals.
Wow, that's awesome.
Yeah, your site's fabulous and your company's fabulous.
Well, I appreciate that feedback. And we'll be following up with you shortly on getting your monster box shipped to you. Congratulations again.
Thank you, doctor.
So click the link below because the next big winner could be you.
The silver and gold markets traded positively this week. The spot gold price finished just over $2,360 an ounce bid, while the spot silver price closed above $28 an ounce as it threatens for another rally towards $29 and possibly $30 soon. Johnson Matthey, a major platinum group metals and auto catalyst maker, stated in a report this week that platinum in 2024 is set for its largest supply deficit in over a decade. Now, with the spot price of platinum now nearly equal again to the spot price of palladium, perhaps we should take a brief look back at how precious metal supply deficits inevitably lead to futures exchange withdrawals and then unsecured ETF raids for remaining bullion supplies. NYMEX platinum warehouses have already been raided by mostly Chinese demand since COVID 2020, and it appears taking of underlying platinum ETF supplies has since followed, and is likely to continue with this year's decade-high supply deficit to come. On the silver demand outstripping available new line supplies, we're on the course this year to again see mammoth deficits, the supposed second highest throughout most of this 21st century to date. Raiding the COMEX silver warehouses kicked off in 2021, and unsecured silver ETF raids are ongoing as well. LBMA data updated this week revealed the City of London's holdings of silver bullion have never been lower. Gold in the City of London has also been diminishing and flying out the doors of late as well. Underlying silver bullion stockpiles backing the Shanghai Silver Futures Exchange are also hitting historic low levels, while the Chinese continue paying premiums of more than $3 an ounce over spot on large commercial 1,000-ounce bars. The red line, bottom half of this chart, demonstrates on a fiat Chinese yuan premium paid for silver at exorbitantly high levels currently versus the last 15 years of data. Turning to vanishing available gold supplies, the never-before-seen divergence between the spot gold price climbing record-breaking walls while Western unsecured gold ETFs lose underlying physical bars to Eastern demand and record-buying central bank demand can also easily be seen in the collapsing COMEX gold warehouse stockpiles. Over 20 million ounces of gold have upped and left since the COVID 2020 4GC agreement between COMEX and London. Now, if you want to pay annual fees to day trade unsecured precious metal ETFs, good luck. But here's a picture of the proxy you don't own on the right. I suggest your core holding be physical bullion owned outright. Turning finally to this week's reminder of how market riggings eventually end in exploding spot prices, Goldman Sachs just resolved the decade-old platinum and palladium market rigging lawsuit that began in 2014. My guess is that Goldman had a hand in raiding NYMEX palladium warehouses and then unsecured palladium ETFs, only to have the spot price of palladium more than six-fold trough to peak over the last decade, spanning the time it took to settle this latest precious metals market rigging lawsuit. In the end, physical supply and demand won out, and the spot price climbed walls, multifolding in a handful of years of recent fiat financialized history. It most certainly will not surprise me to later this decade see a similar situation play out for gold, platinum, and silver respectively. I hope you have your prudent bullion positions before supply shortages make spot prices go manic. That will be all for our weekly SD Bullion Market update, and as always to you out there, take great care of yourselves, those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.